Here is the contradiction that opens the whole issue. On July 2nd, one-week jobs report was read two opposite ways on the same screen. The Dow jumped more than 1% to a record high, and on the exact same tape, semiconductors were routed for a second straight day. The main semiconductor fund down 4.5%, Teradyne down almost 14%. A record and a rout, printed by the same number. That gap is the whole story. Now here is what everyone was chasing. In the second quarter, the semiconductor group ran up 88%, its best quarter ever, the most crowded trade on the tape. Then, in a single session, it broke. One analyst asked a simple question out loud. Can the cloud giants keep spending on artificial intelligence if they cannot show investors a return? 2 years of paying for the spending just met a demand to prove it works. So where is the edge? Not in the crowd, and not in the consensus hedge of gold over technology, which is now itself the crowded trade. It is in one number the market just mispriced for you. Teradyne, the company that tests the chips, was sold down almost 14%, as if demand had peaked. But its revenue just grew 87%, a record quarter for artificial intelligence test. Sold 13% while growing 87%. When the index and its engine disagree, believe the engine. This is the asymmetric. This is the asymmetric, issue 35. The two tapes, tech and crypto investing for thoughtful retail from an operator's lens. Yesterday's issue called the artificial intelligence hardware router dispersion, not a direction, and told you to sort the wreckage by scarcity. Today, the same event did something new. It split the screen in two, a record high and a sector crash, printed by one jobs report. Here is the one-line read. On July 2nd, the June jobs report landed at just 57,000 new jobs, roughly half of what was expected, and the weakest in 4 months. The market reacted in two directions at once. The Dow jumped nearly 600 points, up 1.14%, to a record close of 52,900, on the dovish read that a weak labor market takes rate hikes off the table. On the exact same tape, semiconductors were routed a second straight day, the main semiconductor fund down 4.5%, led by Teradyne down almost 14%, and KL down 11.5%. The S&P 500 sat nearly still, torn between the two. Gold broke above $4,100, the dollar slipped, and Bitcoin reclaimed about $61,500, even as its exchange-traded funds bled a record $4.5 billion in June. You'll see the same labels throughout. Confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, a record and a rout on one jobs print. The divergence is the story. The 30-second frame. 1 print 2 tapes, the jobs miss drove the Dow to a record and the semiconductors to a rout at the same time. 2, the record is dovish rates, not strong growth, a weak number the market liked because it pins the Federal Reserve. 3, the rout is a crowd unwind plus a new question. The semiconductors had run 88%, and then an analyst asked whether the artificial intelligence spending will show a return. 4, the hedge is now consensus, gold over technology, which compresses its remaining edge. And 5, the tail is calm, oil near pre-war levels keeps a lid on inflation. Start with the two tapes. On July 2nd, the Dow jumped nearly 600 points to a record close of 52,900, as cyclicals and rate-sensitive names were bid on the dovish read that a weak labor market pins the Federal Reserve. And on the exact same session, semiconductors were routed a second straight day. The main semiconductor fund down 4.5%, led by Teradyne down almost 14% and KL down 11.5%, with the Philadelphia Semiconductor Index down more than 7%, its worst 2-day stretch in months, after its best quarter ever. The S&P held nearly flat, torn between the two. Most days the index and its internals tell the same story. This one told opposite stories. The consensus says, new all-time high, the bull market is intact. Our variant, the high is a rotation artifact, and a record that needs a weak economy to exist is a fragile one. Read the internals, not the headline. Now the catalyst, a weak jobs print the market liked. June payrolls rose just 57,000, roughly half the 115,000 consensus and the weakest in 4 months. Unemployment was 4.2%, but flattered by participation falling to a 4-year low. Leisure and hospitality shed 61,000 jobs, and the prior 2 months were revised down. The market rallied the Dow to a record because the labor market is cooling. And cooling takes tightening off the table, with the odds of a September hike cut to about half. But strip away the rate lens, and the print is a yellow flag. The consensus says soft jobs means a dovish Federal Reserve, so buy everything. Our variant, the print pins the Fed on hold, not cutting, and the durable signal underneath is a labor market decelerating faster than inflation is falling. Favor present tense, cash flows, and genuine scarcity over long-duration promises. Macro 3, the dovish cushion, and the drain assets confirm a rate move, not a growth move. Gold broke above $4,100 on the weak jobs, lower rate impulse, cited by level and driver, never a contested return. The dollar slipped, and the 10-year eased. But gold over technology is now the crowded hedge, so its edge compresses. Bitcoin reclaimed about 61,500, up more than 2% off a 58,000 low. After the Federal Reserve Chair said inflation risks had eased. Yet the tell to respect is the divergence within crypto. The price rose while its exchange-traded funds bled a record $4.5 billion in June, their worst month ever, and several treasury companies now hold their coins at a loss. It is a rally the flows do not yet confirm. And beyond profit-taking, the chip rout had a second fuel. An analyst at Citi questioning whether the cloud giants will sustain their spending without a return. 2 years of pricing on spending growth just met a demand for a return. Part 2, in focus, the single worst name in the semiconductor tape just grew revenue 87% and was sold as a demand peak. The in focus name is Teradyne, and it fell almost 14% on July 2nd, the worst performer in the semiconductor group, yet its own numbers point the other way. Teradyne sells the machines that test chips. Its revenue is a bet on chip complexity and verification intensity, not on chip unit growth alone. In the first quarter, it reported revenue of $1.28 billion, up about 87% from a year ago, with roughly 70% of that revenue driven by artificial intelligence, up from about 60%. Its memory test business, serving high-bandwidth memory, hit a record of about $200 million. The company's own filings with the Securities and Exchange Commission confirm a revenue base near $2 billion in the last comparable upcycle year, and the current surge is a step change above it. Now the mechanism, why content per chip rises even if wafer volumes flatten. The rout sold 3 different layers as one. Layer 1, the verification layer holds. High-bandwidth memory stacks and advanced packaging require more test time and more coverage per device. A giant renting out spare chips does not reduce the test that a new memory stack needs. Content per chip rises with complexity, even if units flatten. That is Teradyne and KLA. Layer 2. The capacity layer takes the hit. The compute rental clouds sell an undifferentiated chip hour, and that is the layer a glut genuinely threatens and where oversupply lands first. And Layer 3, the demand for a return adds a tailwind, a market that suddenly wants proof the spending works needs more verification, not less, which is exactly what test and inspection sell. The market sold a complexity story as a unit demand story. The debate, the bull, complexity is the thesis. The worst hit name in the tape grew 87% with record memory test demand and a rising artificial intelligence mix. The 14% drop is crowded trade beta and a peak reflex, not a franchise event, and a market demanding proof of a return needs more verification, not less. The bear, priced for perfection. Teradyne is up about 300% in a year into a guide that is first half weighted. Management's own signal of a softer second half. Test equipment is famously cyclical and lumpy, orders can air pocket fast, and 70% concentration in artificial intelligence cuts both ways. The referee is memory test bookings and the second half guide. The read, a research view, not a call. Teradyne is this issue's spine in one name, the 14% epicenter of the semiconductor rout that just printed 87% revenue growth, a record memory test quarter, and a rising artificial intelligence mix. The complexity side is real. Test and inspection content grows with harder chips, and a market demanding proof of a return needs more verification. The risk side is equally real. a cyclical test equipment business inside a stock up about 300% in a year, with a guide that telegraphs a softer second half. The discipline is not by the dip. It is to separate the rising content per chip, the thesis, from the 300% move and the cyclicality, the risk. What would change the read? The guide or the memory test bookings get cut, versus the bookings and records extend and content per chip keeps climbing. Step back to the dividing line, content that rises with complexity versus capacity that a glut commoditizes. The tape sold the whole semiconductor complex as one demand peak trade. The useful sort is not memory versus logic. It is content per chip rising versus capacity for rent. So own the content that rises with complexity, chip test and inspection, sold out high bandwidth memory, advanced packaging. Content that grows as chips get harder to build even if wafer units flatten. Own the self-funding machine, the platform owners that monetize their excess, and the hyperscaler that funds the biggest build on Earth from its own cash. And price commodity capacity as an option. The pure compute rental clouds and commodity memory, undifferentiated capacity facing entry by better capitalized incumbents, the part a glut hits first. Part 3's thematic signal, from spending growth to spending return, and the state capitalism turn. The week's 2 artificial intelligence headlines rhyme. First, the analyst at Citi questioning whether the cloud giants can sustain their spending without demonstrable returns, the fuel for the second-day chip rout. Second, the Financial Times reported that the lab OpenAI has proposed handing the United States government a 5% stake, worth roughly $42 billion, as part of a pitch under which Washington would hold 5% of each leading American artificial intelligence lab through a public wealth fund. It is early stage and unconfirmed by the other firms. Both stories re-underwrite artificial intelligence on returns and control, not growth and momentum. The next leg is gated less by capability, still rising, and more by who gets paid and who decides, which favors provable economics and defensible scarcity over names whose pitch is simply more spending. Part 3, the read. When the index and its engine disagree, believe the engine. What we are watching over the next 4 weeks. The third-day follow-through in the semiconductors, rotation or a top. The Federal Reserve's first decision under its new chair, hold versus cut, in about 4 weeks. The July jobs report to confirm or refute the June cooling. Megacap earnings, and above all, whether their spending shows a return. Teradyne's memory test bookings and its second-half guide. Bitcoin's exchange-traded fund flows. Whether the price reclaim earns an institutional bid. Gold against $4,000 and the dollar. Whether the record broadens beyond a handful of names. And OpenAI's government stake pitch. The scorecard, our open, dated, falsifiable calls tracked publicly. The record is a rotation, not a breakout. Teradyne, complexity sold as a demand peak. Test and verification outperform the glut layer. Macro, a soft print pins the Federal Reserve on hold. Bad news is good news but with a shelf life. Crypto, price up, flows out. Gold, cited by level and rate driver, but now a crowded hedge. Spending growth to spending return, prove the yield. The state capitalism turn. And concentration, why a flat index is not comfort. Full detail lives in the assumptions ledger. The bottom line, 2 tapes printed on one screen, a record Dow and a semiconductor crash, both reactions to the same weak jobs number. That is not a paradox to reconcile. It is the regime showing itself. The record is a rotation into cyclicals on a dovish print, not a broad breakout. What cracked is not artificial intelligence. It is the market's willingness to pay for the spending without proof of a return, and the consensus response, sell technology and buy gold, is now itself the crowded trade. So the edge is in the layer the tape mispriced, chip test and verification, sold down while growing 87%, because a market that suddenly requires proof needs more verification, not less. Own the self-funding machines and the rising content inputs, price commodity capacity, and any rally the flows don't confirm as an option. Research and educational only, not financial advice. This has been the Asymmetric, Issue 35.